millionaires.
This study, with over 10,000 participants, gives us an empirical, not anecdotal view of how real wealth is built. And it confirms that the path to wealth is overwhelmingly consistent and disciplined. It's not about luck or finding the next Bitcoin. It's about building value over time.
So what are the specific wealth-building strategies that keep showing up in this study, the real how-to-get-rich playbook?
It details these fundamental, repeatable actions. It includes investing consistently and maximizing a 401k, often starting very early in life. Another key strategy is owning investment assets, like rental properties. There's a high correlation between wealth and real estate holdings.
And avoiding debt.
Crucially, avoiding consumer debt, especially high-interest credit card debt. And finally, creating real value, either through a high-income career or a business, and investing those returns wisely.
And among the different paths to millionaire status, which one is identified as the easiest and most common way?
The sources clearly identify the saver investor path. That's the most common and accessible way to do it. These aren't necessarily the people earning $500,000 in IB. They're people who earn good incomes, live below their means, save aggressively, and invest consistently, letting compounding do the heavy lifting for decades.
It's discipline over high-stakes risk.
Precisely.
And we have this stark contrast to this in the source, 20 things poor people do that the rich don't. This highlights a difference not just in actions, but in core beliefs.
The contrast is sharp. It focuses less on income and more on habits and psychological barriers. It contrasts the disciplined financial actions of the wealthy budgeting, saving first, focusing on assets, with habits associated with financial struggle, like overspending and impulse buys.
And the belief system is often the differentiator.
It is. Data shows those in financial difficulty often harbor beliefs about fate, a lack of personal responsibility, whereas the wealthy tend to believe they control their financial destiny. And we have to acknowledge the source material from Chicago Booth notes that poverty itself changes your mindset. It can lead to scarcity thinking that prioritizes immediate needs over long-term gain, creating a self-reinforcing cycle.
Okay, let's talk about how people feel about their money. Our sources point to a fascinating disconnect between subjective feelings and objective financial reality.
This is a major finding. Despite the fact that average financial well-being scores have been stable, consumer confidence has been consistently declining. Only 46% of Americans view their finances positively.
So objectively, many people are doing better than they feel they are.
That's what it suggests. Their savings might be up, their debt is manageable, but they feel anxious, maybe due to negative media or comparison culture.
So how do we actually define financial health beyond just a bank balance or a credit score?
A robust framework for this requires looking at both subjective and objective indicators. The subjective indicators are your feelings and worries. Do you feel secure? Could you handle an emergency?
And the objective?
Those are the measurable metrics.